The webinar will begin in approximately 1 minute. Welcome, everyone. We are pleased that you have joined us for today's webinar titled Hidden Details in the New RMD Tables. The webinar will last approximately 20 minutes, and at the end, you will be given an opportunity to receive supporting materials by email free of charge to you. You will also be told how you may email questions related to today's content to the presenter. Today's presenter will be Linus Sugis. Linus is the president of Advanced Underwriting Consultants. He and his team answer tax and technical questions posed by producers every day. Linus also spent 14 years working in the home office of a life insurance company in various roles. He also started, ran, and sold an estate planning law practice in the Nashville area. Linus will draw on his legal and life insurance experience during today's webinar. And here he is.
Thank you very much, Amber, and welcome everyone. I'm glad you've joined us here today. We're going to talk about hidden details in the IRS's new published minimum distribution tables, new life expectancy tables. But before we get into that, let's agree on what it is that we're going to talk about next month. As a reminder, we put on these no charge webinars, open and available to anybody on the first Wednesday of every month. Next month's webinar will be on Wednesday, April 6th. And it's always at 11 a.m. Central Time. Adjust accordingly for where you are. And what I'd like you to do is I'd like you to pick out of the three. Your three choices are IRS publishes new Section 72T rules. The second choice is free online resources that you may use in your business. And the third choice is a big mistake made with a self-directed IRA. I'm going to go ahead and open the poll. And give everybody an opportunity to vote on what it is that they would like to hear about next week. So please go ahead, cast your vote. I'll leave that open for about 30 seconds, and then we'll come back and engage on today's webinar. If you haven't yet voted and would like to do so, please go ahead. I'll give you a couple more seconds. All right, I'm going to go ahead and close the poll, and next month's topic will be IRS publishes new Section 72T rules. Thank you for that. Thank you for your participation, and thank you for being here today. So let's go ahead and talk about hidden details in the new minimum distribution tables, the new life expectancy tables. Here's what we're going to talk about today. First of all, we're going to cover some background information about the tables. Secondly, we'll talk about how the new life expectancy tables will affect IRA and qualified account owners that are living. Then we'll talk about inherited qualified accounts, IRAs, and qualified plan accounts. We'll talk about inherited non-qualified annuities and how the tables affect those. And then we'll touch on Section 72T and 72Q and how the new life expectancy tables might affect those kinds of calculations. So let's go ahead and get started with a little bit of background information about the new life expectancy tables and how they affect RMDs. So we've been expecting these tables for a long time. They were first published back in 2019. They were published in the Federal Register, and there's a hyperlink there in the slide on your screen. And the bottom line is that the new tables reflect longer life expectancies than the ones that were in effect prior to the publication of the new tables. Now, those life expectancies may actually be affected by the pandemic, and life expectancies as a result of the pandemic probably are shorter than than reflected in the tables. But things in the federal government, things with the IRS do take a long time to come to implementation. And so these expectancies in the tables were current as of the time they were first published. The new tables are effective beginning January 1st of this year. And so we have longer life expectancies to deal with. What does that mean in the real world? Well, here's a quick example. This is the old uniform lifetime table that we use to calculate minimum distributions for qualified plan and IRA accounts. This is the table that you're used to seeing if you did hand calculations for your clients in the past. And here's the new table. You can see just at a cursory glance that the numbers are different under the new table. And to pull out an example, for someone who is 72 and is calculating their first RMD, what we used in the past was a life expectancy of 25.6, a life expectancy factor of 25.6 under the old table. In the new table, we use a life expectancy factor of 27.3. The bigger factor means that minimum distributions are small work for somebody in the real world. So let's talk about how an RMD might be calculated for somebody who is alive. And let's assume that we've got Mary, who turned 72 in 2021 and had an IRA balance at the beginning of the year of $500,000. So using the old uniform life table factors, calculating her minimum distribution would take the beginning of the year account balance, or end of the prior year account balance if you prefer describing it that way, $500,000, and it would divide it by the factor from the table for a 72-year-old. Under the old table, that factor was 25.6. And so when you divided $500,000 by 25.6, you came up with $19,531, and that would have been Mary's minimum distribution requirement for 2021. Those of us who are on the call are aware of the fact that Mary's first RMD from that IRA could be taken as late as April 1st of this year. Let's assume that she took that amount out last year. And let's also assume that after she took the amount out, the account grew back. And it grew back to $500,000. So it was exactly equal to the beginning of the year 2021 account value at the end of 2021. And so Mary, in calculating her RMD for 2022, would use a factor for a 73-year-old because that's the birthday that she's turning in 2022. The IRS says she'd use the new table, not the old table. And so she would pull the factor for a 73-year-old from the new table. Well, the factor for a 73-year-old from the new table is 26.4. That means that even though Mary is older, and even though we are assuming that the account balance is the same as it was for last year's calculation, the RMD is actually going to be less for Mary. In this case, it's $18,939, and $600 less than was required for the prior year. So the observation for those who are on this call is if you weren't already aware of it, it is quite possible, even quite likely, that for many clients who have been taking minimum distributions from their qualified accounts, their RMD for 2022 is going to be less than it was for 2021. Not for everybody, but for a lot of people, because of the more generous life expectancy factors in the new table. And so if you're looking for a reason to contact people that are taking RMDs, this would be one to give them a heads up that this year's RMD might actually be less than what last year's RMD was, and that may be different from their experience in the past. So anyway, that's how it might affect the living owner of an IRA account. Let's talk about inherited qualified accounts, because this change is a little bit more nuanced and a little bit more subtle. Let's talk about Frank. Frank inherited his mother's IRA in 2019. And why is that important that he inherited in 2019? It's because he's pre-Secure Act and he still had the ability to stretch based on his life expectancy. So let's assume that that's what he did. Under the normal rules for an inherited IRA, Frank would look at the birthday that he turned in the year after his mom's death. That would be, he turned 55 in 2020. And he'd pull the factor from the old single life expectancy table for a 55-year-old, 29.6. Normally, he would have divided the beginning of the year account balance in 2020 by 29.6 to come up with his minimum distribution. Well, we had a special rule in 2020 which said that no RMDs were required from either regular accounts or inherited IRA accounts in 2020, thanks to the CARES Act. So Frank didn't need to take an RMD in 2020. He did need to take one in 2021. And the way that that's calculated is you use the beginning life expectancy factor, the age 55 factor from 2020, that was 29.6, and you'd subtract 1 from the beginning factor and come up with 28.6. And that's what the factor you'd use to divide, to have the beginning of the year account balance divided by. And so for 2021, if his account balance was 50 grand, he'd divide by 28.6 and come up with a minimum distribution of $17,483. Well, under the old rules, under the pre-table change rules, we'd continue subtracting 1 from Frank's beginning factor for every year that passes. And so we would normally expect Frank's factor, dividing factor, for 2022 to be 27.6. But that's not what the IRS said. Here's how the IRS said things should work. So we're going to reset Frank's initial factor, the one that we started with in 2020, and reset it to the age 55 factor using the new table. And so instead of using 29.6 as the starting point, we're going to use 31.5, which is the life expectancy factor for a 55-year-old under the new table. So we're going to use 31.5. And then in 2022, since it's 3 years after when he started, we're going to subtract 3 from that 31.5 factor to come up with a life expectancy factor for Frank for 2022 of 28.5. And so if the inherited IRA has a beginning of year balance at beginning of this year of 500 grand, his payout is $17,544 using that new factor, that new recalculated factor. And again, Frank's RMD for this year is less than it was for last year. And so that's one of the things that's hidden in the new rules, that we're recalculating RMDs for inherited accounts that are pre-secure inherited accounts based on the new factors. And so it's something that you need to be aware of. If you've got non-spouse beneficiaries of qualified accounts, IRA accounts, that have been taking RMDs based on pre-Secure Act rules, it's a good idea to touch base with them and let them know that their RMDs are going to be calculated differently, and their RMD for this year may in fact be lower than it was last year. So let's talk briefly about inherited non-qualified annuities. Let's talk about the example of Elizabeth, who inherited her father's non-qualified annuity in 2020 and has elected to stretch based on her life expectancy. So in Elizabeth's case, even though her father passed in 2020 and the Secure Act is effective for deaths of account owners for 2020 or later, the Secure Act does not affect the rules with regard to inherited non-qualified annuities. And so we still have the ability, even under non-qualified annuities that are inherited this year or later, to have the non-spouse beneficiary stretched based on life expectancy. So Elizabeth falls into that category. It's an inherited non-qualified annuity. She turned 49 in 2021, the year after her father's death. So the starting point for calculating minimum distributions from the non-qualified annuity is the factor from the old single life expectancy table, 35.1. If, again, we're assuming a $500,000 account balance, the RMD would be $14,245. For 2022, just like with inherited IRAs or inherited qualified accounts, we're going to recalculate Elizabeth's life expectancy factor using the new life expectancy table. And so we pull the factor for a 49-year-old from the new table. That's 37.1. And so for this year, we use a 36.1, the original recalculated factor minus 1 to get 36. We use 36.1, and we divide the beginning of the year account balance, and if we assume that's $500,000, her new RMD from the inherited account for this year is $13,850, which again is lower than what it was for last year. And so to the extent that we've got clients who have inherited non-qualified annuities, who are non-spouse beneficiaries, who are taking minimum distributions, it's a good chance to visit with them, alert them to the fact we're going to be using new life expectancy tables to calculate RMDs. And for 2022, the minimum distribution is likely to go down, is likely to be lower than what it is that they expect. So it's an opportunity to talk to those folks. So let's touch also briefly about section 72T and 72Q. You know, I'm not trying to be cryptic. The tax code says in code section 72T that you can avoid the early distribution penalty tax on qualified account distributions if you have substantially equal distributions based on your life expectancy. And if you do that right, you avoid the 10% early distribution penalty. Likewise, on non-qualified annuities, the taxable portion of distributions taken prior to age 59 and a half risk a 10% penalty tax, but that penalty tax can be avoided if there are substantially equal distributions based on the account owner's life expectancy. And so when we refer to section 72T or 72Q distributions, that's what we're talking about. We're talking about distributions that are taken prior to age 59 and a half that are intended to avoid the 10% early distribution penalty tax. So the IRS has recognized 3 ways that tax can be avoided. There are 3 ways to make calculations: the annuitization method, the RMD method, or the amortization method. We're not going to get into that in this short webinar. We'll probably end up talking about this more next month based on your choice of webinar for next month. The bottom line is that those calculations are frustrating for a lot of our clients because in many cases they don't really yield enough income to meet the taxpayer's objectives. At least that's our experience. We get calls from producers all the time who are working with clients, and when we point them to calculators or explain how these calculations work, the distributions under 72T or 72Q are not adequate for the taxpayer, and that's frustrating from our client's perspective. The new tables haven't made that any better. Since life expectancies are longer under the new table, the calculations under all three of the methods for 72T or 72Q distributions will be lower, all things being equal. And so that's going to be, that's a bit of an issue for our clients. But there are some new regulations that might give us some relief in that regard, at least in the short term. And so we'll talk about that a little bit more next month. We won't get into that today, but we'll talk about it more next month. But you should be aware of the fact that those who are considering 72T or 72Q, the rules have changed. Some of the calculators online have not yet been updated to reflect the new rules. And so if you're visiting with a taxpayer about that, get some extra advice to figure out how the new rules might affect them. So what should we take away from today's webinars? Well, we've got new tables. New tables calculate RMDs, substantially equal distributions, and the tables have some hidden effects in that they may affect 72T, 72Q calculations, and they may have substantial impact on those who have inherited qualified accounts, IRAs, non-qualified annuities in the past, and may be surprised by the fact that their minimum distributions are actually going to be lower in the coming year. So it's a good reason to touch base with those clients. The new tables will also lower RMDs for those who have already reached the required beginning date on qualified accounts. Again, a good reason to touch base with those clients. So, the bottom line, from these webinars is often, well, you've got a reason to go talk to your clients, and today is no different. You've got a reason to talk to people about how these things have changed, what it is that they're doing. It's an extra reason to touch base with our best clients that have nothing to do with selling them anything. And so, from my perspective, if you come at it from a service perspective and you touch base with those folks, you do serve them better, and you have an opportunity to work with them when the time does come to help them implement certain kinds of financial products. So at this point, I would like to turn the program back over to Amber to help wrap things up. Amber?
Thank you for joining us today. As a reminder, if you would like to receive supporting materials, feel welcome to email us at asktheexpert@advancedunderwriting.com. You may also email questions related to today's webinar. Feel welcome to join us for the next webinar on the first Wednesday of next month, which will be April 6th at this same time. Next month's webinar will be titled IRS Publishes New Section 72T Rules. You can also find an archive of past webinars on our YouTube channel, Advanced Underwriting Consultants. Please subscribe to our channel. It helps us to keep making free webinar content. Today's presentation will be posted on our YouTube channel by the end of this week. Finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact us at 615-224-1291. That's 615-224-1291. Thanks again, and best wishes for continued success.